how do we review our investment performance, our investment strategy? For us to start investing, it's very important for us to find out what is the appropriate, what is the optimum return on investment that we can target for. Because for someone to invest aiming to achieve 20% return a year, and someone intend to achieve 6% a year, is a totally different ballgame. So that's why, of course, we know that 20% a year kind of return, it may not be sustainable over the years. Okay, so that's why you want to find out what is the return, that you can achieve, which is achievable for you, and then will be able to help you to beat inflation, compound your wealth, so that you'll be able to accumulate enough wealth to achieve and to attain the financial goals that you've got. Now, you see, the tricky part about aiming for this investment return is that if you aim too high return, like what I said just now, you aim for 20% return, 30% return a year, chances are, instead of accumulating more wealth, those risky investment that you put your money into, chances are it may get depleted or it may get wiped out totally. So for that matter, there is a danger of investing, aiming for too high return, especially when you are investing for serious money. Okay, now you may want to ask me, Mr. Yap, then how high is high? Okay, I am licensed professional by Security Commission to advise my client to grow their wealth in a steady, in a high certainty manner for them to achieve financial freedom. So of course, in that case, I'll be more conservative than most people that you talk to, or maybe even other professionals that you talk to. So to me, if you're looking at investment return, which is more than 12% per year, to me, that is a too high return to aim for investment, because we're talking about 12% or 11%, not 1 year or not 2 years. We are talking about on average 11 or 12% over 30 years of your life, 40 years of your life. So that is definitely not so easy to attain. Okay, and for that matter, I would call that's not investing, but that is more like speculating. Okay, but if you target too low the return, or you don't care about what return that you are getting, then your money are all like staying idle in the bank, then chances are you may get 2% return or even 2.5% return. Then your money will be growing very slowly. Actually, in fact, it doesn't grow, even though it looks like it's growing, because the actual inflation of 5% or 6% or even 8% is depleting, or is actually reducing the actual value, the actual purchasing power of your money. Okay, and that will certainly become a big obstacle for you to achieve your financial freedom. So I always believe that when we invest our hard-earned money for serious financial goal, like to retire, it's important for us to make sure that we only invest in quality investment. Okay, before this, many people ask me, Mr. Yap, what do you mean by quality investment? Okay, so I gather that maybe it's time for me to introduce the kind of standard or the kind of criteria that Whitman use for our clients who pay us fees. Okay, when we help them to select the investment to grow their wealth to achieve their financial freedom. So I have just published a book called Financial Freedom Investing, and in this book, I have first time introduced this criteria using what I call SRB standard. Okay, for the first time to the public. Okay, before this, I only share this to my client and to the client of Whitman. Okay, S stands for safe, investment which is to be safe got to be regulated. It got to be a regulated product. It must have a third-party trustee. It must have a clear underlying asset, whether it's investing into share, whether it's investing into a bond, or whether it's investing into precious metal or blah, blah, blah. Okay. There shouldn't be margin, loan, or leverage. It should be aiming for moderate risk or moderate return, not too high return, and it should be bought or invested and kept custody with the regulated provider. And when I talk about regulated provider, by regulator, I really mean Malaysia regulator, because any regulator outside Malaysia is really beyond our reach, and we may not get the kind of protection that we can get from our local regulator. And B stands for always rises in the long term. So the investment that you invest into must have got the underlying asset that we know for sure that over 5 years, 10 years, 15 years, or 20 years from now, the investment will continue to be there. And in fact, the investment can continue to appreciate in value. No? So then we call this investment. Okay. But if an investment which is like very volatile, up, down, 10 years later, could be down, then I would think that this investment will not fit the criteria of SRB for you to really work, for you to invest a lot of your money. And third, best of breed, which means to say whatever investment that we choose to invest, we must do a fair comparison and research to compare. For example, if you want to buy this particular share, say this is a banking share, it's only fair that we compare that this particular banking share with other banking share to see whether we are getting a good value of this banking share. If you were to invest into this particular unit trust fund of China, it's only fair that we compare to other China fund, okay, to see whether this particular fund belong to the best of breed category for us to put our hard-earned money into. So this is what I mean when you invest. Don't simply listen to your friends, listen to your maybe any salesperson who come to approach you. Use this SRB standard as a guide to filter this investment proposal to make sure you only invest in the investment that you can sleep sound at night, and you know that you can continue to be there to support you when you are in your retirement years, when you don't have active income and you may not have energy to work to get active income anymore. Okay, cool. Now, talking about investment, I believe we need to be also very practical. We need to talk about the subject as to when should we take action. Many people know a lot of investment theory, investment strategies, but when it comes to execution, when it comes to taking action, something is always missing. So for that matter, I want to refresh for those of you who already know what I'm going to share now. And for those of you who do not know about this, okay, let me share with you. This is the insider secret for a lot of fund managers. Okay, in our life, when we invest, we need to know there are two cycles that we should look at. Number one is the economy cycle, which will go down when there's a recession, and then it will recover, and then it may go down again. It's a cycle. It will go up, down, go up, down. But there is also another cycle that which is also important when we invest, which is stock market cycle. This is like the red color here. It may be at the bottom, or we call it, this is a bear market. Okay, then slowly it becomes a bull market, and it will peak. Then up from the peak, it may stay for a few some time. Then after that, it may start to become bear again. Okay, so a lot of people, especially laymen, always think that okay, I should invest my money when the economic situation is very good, very booming, because that's where stock market will do well. Okay, unfortunately, that's not true. Okay, why? based on the research over the years by the fund managers, by the economists, it is found that this is the behavior and this is the relationship between economic and stock market cycle. For a lay person who say that, no, I only want to invest when I see the good news reported, growth reported in the newspaper headline. Now, that will be when? If you look at this chart, it will be somewhere here, no? Where there will be a clear sign of the end of recession, economy started to run, it will be somewhere here. But if you start to invest somewhere here, where is the status, where is the stage of stock market cycle? You will see it is between middle bear, or sorry, middle bull to the point of late bull already. So in the layman terms here, that it means that compared to the bottom here, when you want to invest here at the end of the recession, the beginning of the booming economy, then you will find whatever discount that you can see in the China market, technology sector, US market, or even Malaysia market, all this discount will be gone. You'll find that a lot of prices of this kind of fund or this kind of investment or share has become quite expensive already. Not the most expensive, but quite expensive compared to where it used to be. And that's why, that explains why many investors, they will miss the opportunity of buying at the market low. Okay, because when you wait for the wrong signal to enter the market, unfortunately, you will feel that it's too expensive, and that many of you may choose not to act and miss the opportunity and wait for another round of market correction, a market low opportunity. And if the same behavior repeats itself, that's where I think it's very difficult to invest and generate the gain and the return to beat inflation and to help us to achieve the financial freedom.